Welcome everyone to the second Stallion podcast. I'm Vincent Beleja, the Chief Investment Officer of Stallion Capital Management. With me today are
Brian Outlaw, Director of Business Development.
Jeremy Youngbauer, Director of Investor Relations.
Mitchell Chavez, Director of Asset Management.
Today we wanted to give an update on our fund performance for Q1, even though it's already May. We'll actually be going year to date on both the debt funds that we have, that's Stallion Texas Real Estate Fund 1 and 2. Then we're going to be talking about the Stallion Growth Fund, new developments with that fund. And with that, we will start off, and then from there, we're going to go into updates, really what we're seeing with the economy right now and how that's going to affect real estate investments. And then what our strategy is for the rest of the year on both funds. And then we're going to do a few frequently asked questions that we have from our investor clients on a regular basis. Just thought we'd address those here. If you have any specific questions, we'd love to hear from you. Just give us a call at the office or email any one of us, Vincent@stallionfunding.com.
Yeah, Brian at stallioncap.com.
Jeremy at StallionCap.com.
Mitchell at StallionCap.com.
So Mitchell is new to this podcast. Mitchell, would you just give everyone an idea of what you're doing right now for the Growth Fund and everything that's on your plate?
Sure. Yeah, I've been on here at Stallion for about 2 years and started full time back in October working on the Growth Fund, primarily focusing on learning the markets, acquiring properties, analyzing properties, and working with our property management team to run the properties as short-term rentals.
Great, thank you. So first things first with Stallion Texas Real Estate Fund 1 and 2, fairly normal quarter for us. We are looking at about a 7%, maybe a 7.2% rate of return for the year. We've had really normal performance for us. All of the loans are proceeding fairly well, even though we do have higher interest rates right now in the real estate market. Our borrowers are still able to sell the properties fairly easily, still have a multiple offer situation. And that's important, of course, because with the Stallion Texas Real Estate Fund 1 and 2, those are debt funds. Sometimes you'll hear us refer to them as income funds, and we can get into why we say they're debt and income funds. But those are funds where we are lending money to borrowers for real estate development or real estate acquisition or construction. And so really by and large, the portfolio has performed very well. Right now, we have switched most of the portfolio to floating rate loans, which is a pretty big deal for us because instead of a fixed rate loan, now every time that the Fed raises the federal funds rate, we increase our rates. So that can be a really good thing for investors. You guys have talked to investors about that. What's some of the feedback that you've received from the floating rate?
Yeah, they really like the concept because it makes sense in an environment where interest rates are rising and inflation is something that we're all feeling. It's a really nice component to the fund to have a strategy that can help keep up with inflation and increase yield in this environment.
Yeah, that's right. One of our main questions that I get is, okay, what are you guys doing in this rising interest rate environment? And exactly what Vincent said, we went to the floating interest rate loans last October in anticipation for what is happening now and to protect the fund and investors, and we're seeing it work out, which is pretty awesome.
So as of this recording, the Fed increased rates by 25 basis points and then 50 basis points. And so we've done those same steps inside of our portfolio. And every new loan that we are originating, it's the prime rate plus a margin. And so our borrowers have been very understanding about that. Everyone is in this together as far as inflation goes. And so we want to give our investors every opportunity to do really well in this environment. We don't know what the Fed is going to do as far as how many more rate hikes they might have. We're guessing another percent, maybe more than that, but we're geared up for it. And because these loans are short-term in nature, we're not seeing a lot of borrower distress from these things. I mean, after all, it only has been 75 basis points total, but the profit margins are still really pretty strong from the borrowers, and we haven't seen a significant decline in real estate values right now. And so when they are going to sell those properties, they're still able to cover all of their debts and still have their profit margin. So really, all in all, we've been very busy this year. So far, I think we've put out about $40 million, maybe $43 million so far this year in the debt funds. So a significant amount of capital. those funds are still open. And what we find is we're going to have probably more demand, really kind of increasing demand throughout the course of the year. So about, again, for most, I'm thinking 7.2, but if we do have more interest rate increases, we could see that go as high as 8. It really just kind of depends on what the Fed's going to do with that.
And question on that, just for people to understand, when you talk about increased demand, what's the typical profile of a borrower and the type of deals that we're originating loans for?
Sure. So really, there's two types. There's either someone that is kind of our bread and butter, which is a small builder. They might build 5 to 10 homes a year, and they're going to go in and buy a lot or multiple lots, and then go vertical with those structures. So they might be building a house, they might be doing a duplex, or maybe multiple condo units. They're going to try to maximize the value of what they're buying. But they're also trying to deliver something that will be absorbed in the market. So not going too high, but building something that's nice, that'll create demand in and of just how it's designed. And then the other borrower that we have are more, if you were developers, where they might be buying a larger piece of land. They might be developing lots, or they might even just be adding some type of improvement to do a value add, and they might be going and getting bank lending for the next step in the process. And so one thing that's been in very high demand this year has been land, especially kind of through this COVID era. There's a very low supply of real estate that's on the market right now. I forget, I haven't looked at the past week, but I think we're running at about a month of supply, and there's just not enough residential real estate that's being delivered. And so we have kind of had a land rush almost.
Right.
And you have just a lot of land trading. What happens though is to be competitive, those developers have to come in and offer money that goes quickly to that seller. So whereas you might see normally maybe a 6-month process on buying acreage, we're seeing that might be a 60-day or a 45-day process. And so that's why I think part of our capital has been in so much demand, because very few people can move that quickly on transactions like that. So it's bolstered a lot of what we're doing, and we're bringing in a lot of new clients, but we still have our normal repeat clients as well.
Yeah.
So we'll be busy. We've been busy, and it seems like we will just continue that way for the rest of the year right now. So let's move on to the Growth Fund, which has kind of been the newest fund. Kind of a soft launch in November, and then a hard launch, I guess, on January 1st. This is actually a little chart of all of the properties that we own inside the Growth Fund. Mitchell, you want to just give us a quick overview of what we're trying to do in the Growth Fund, what our strategy is right now for those that may be new to?
Sure, yeah. We primarily targeting new construction townhomes, condos, single-family residential style homes up in the Dallas market. We'll focus on Central Texas throughout the remainder of this year, and really focusing on things that are new, relatively low maintenance, desirable to renters. You list them on Airbnb, they pop because of the way that they're designed, the way that they look. They have a strong amenity if it's a rooftop deck, if it's a big yard, if it's walkability to restaurants and bars. So that's really what we're focusing on right now as far as the Growth Fund goes.
Yeah, I can say the Growth Fund has seen a lot of growth. How many properties are we up to now that we own?
So as of today, we own 9. We're closing on another one this Thursday, and then we have 4 more upcoming that are under contract that are going to close between now and June 15th. So moving quickly.
Yeah, and the Growth Fund is really designed to be an alternative for investors to maybe the traditional equities market for the type of yield that we're looking to deliver, but also comes with being backed by Texas real estate. Mm-hmm. So there's definitely some good downside protection in that, but really aim to be a very strong combination of risk and return for investors.
So let me just maybe give a quick overview of the Growth Fund, what our strategy is, and how that differs from the Stallion Texas Real Estate Fund 1 and 2. So again, the Stallion Texas Real Estate Fund 1 and 2, they are debt funds in the sense that we are lending money to borrowers. Now, sometimes we talk about those funds as our income funds, and we call them income funds because they are sending income out to our investors on a quarterly basis. Probably half of our investors, a little more than half, like to reinvest those distributions. But for the other half, they may use them as part of their income strategy, just turning their assets into a stream of income. So again, at about 7.5%, it works pretty well for them. The growth fund is completely different. As Mitchell was saying, we're going out and we're buying properties now. So instead of making money for our investors through interest payments, now we are making money two ways. One is through rents that are coming in, whether that's we're using more of a short-term rent strategy than a long-term rent strategy, but rents really coming in either way. And then if we have appreciation in the market, the investors also benefit from that. So really two ways that investors benefit. So really the idea is that we're creating a large portfolio of properties. Right now we have typically been buying in the Dallas market, but the idea is direct participation in this portfolio of real estate for our investors. And so it's a very different strategy. It's probably a little bit more volatile, but there's probably a greater reward there. That's really what we're pro-forming. Instead of say a 7 to 8% return, we're looking more at a 12, 13, maybe 14% rate of return, possibly higher than that if the markets really appreciate. But that's what our projections are showing us. And it's really kind of built on a few different things. So the first layer that we're trying to build inside the growth fund is an income layer. And that's really important really for me as an investment manager, because I think appreciation in real estate is great. We've seen the markets really increase in value, and that's fantastic. A lot of people have a lot of equity in their homes right now. But I care a lot more about underlying income than I do appreciation, because income is more reliable. And I think in being an investment manager, that's where I want to create this foundation to where we're buying properties that are creating income for our investors. If we have appreciation on top of that, well, that's great, right? It makes the numbers look good. But I like to be able to count on the income that's coming in. So, Mitch, would you go over some of the income that we're seeing on the properties, or what income we're really looking for when we're evaluating properties? Take us through that process.
Sure. So we'll go on to Airbnb and pull a comp set of some of our competitors, just see what their occupancy is on some of their calendars, how booked out are they for the next month or two, what rates are they getting during their weeknight rents and their weekend rents, and then we'll take that information and put it into our analyzer and say, if we can get this income out of this property, this is probably what we can go and afford to pay for it. So we're pro-forming some of the rental income. Our ADR on all these properties ranges somewhere between $300 and $450 a night. And then we're also capturing a little bit of income on the cleaning. We pass the fee along to the guest, and then we cover our portion, which is the cost.
You said ADR. What does that mean?
It's the average daily rate. So what are we getting on an average nightly rental for any given property, weekday and weekend combined?
Okay. And so what are you looking at right now? What makes you interested as far as a percentage or numbers on an average daily rental rate that you would say?
As far as the number goes for an ADR, yeah, somewhere in between 350 and 400, I would say, is probably our bread and butter. If you start getting up into 450s, maybe more of a premium property with a lot of amenities that really sticks out. If you're a little bit lower than that, maybe a more basic, somebody coming in for a weekday work trip or something like that.
Okay.
It's a good point about the weekday work trip and the distinction between weekdays, right, and then the weekend. You mind telling us the two different strategies that go into both and how we're focusing on maximizing occupancy during those two periods?
Sure. So we hike up the prices on the weekends. We're able to charge a little bit more because you get a lot more vacation travelers, more groups of people coming in on the weekends. We also limit our properties to a 2-night stay minimum on the weekends to capture one guest on Friday and Saturday rather than having 2 or 3 check-ins throughout the weekend. During the weekday, we're seeing more people coming in for business travel, only need to stay one night. They're typically by themselves. We charge a little bit less to be competitive, and we allow them to book for just one night because that's what we're seeing in a lot of the weekday travel.
So we've had a few questions about what properties we're targeting. And so just, and they're roughly, we kind of create this box that we're looking at properties inside of. Right now, it looks like it's from $500,000 on the low side, and we have bought properties that are a little bit less than that. And then on the high side, about $800,000. And the average rental rates are important, but the first thing that I really like to look at is the return that we're seeing on these properties. So every property that we're buying, we're using a combination of cash and that is investor capital that's coming into the fund, and then debt. And we have a couple debt lines that we have right now with local Austin banks. And we like to see on that cash that's being invested about a 20% rate of return. And so when we are analyzing these properties with your analyzer, we're looking to see, can we get about a 20% rate of return reliably? And then is the property new? Is it built within the last 2 years, or maybe it's brand new? We like to have new properties, especially because if we can get them before they come on the market, we can usually get a little bit of a discount on them. Every dollar helps with that. And then we want to see that they do have some type of amenity, right? Mitchell had mentioned a rooftop deck, could be a backyard, it could be something that just separates the property from the rest of the pack, because then we can have an occupancy bump over the rest of the competition, right? We want eyeballs on the side of looking at the properties on Airbnb or any of the other platforms that we're using. So Mitchell, we've had a few questions about, how do we look at, you mentioned looking at other things on Airbnb and getting an idea. What are all the methods, though, that we use to kind of reliably predict the income that we think that we're going to get on these properties?
It's looking at comps, looking at our property's historical data, looking at the historical data that's provided by some competitors I've been able to gather or through our property managers, and really just taking that, performing it out, and seeing what kind of property we can buy, and then experimenting as we go. If we need to raise the rates or lower the rates, depending on how well the property is performing, then we're able to do that on a daily basis with Airbnb.
Gotcha.
And that's a really good benefit in reducing or increasing prices on a nightly basis, basically with the short-term rental strategy, because compared to a long-term rental strategy, right, you're locked in for generally 6 months to a year. As many of our investors and viewers have had long-term rentals in the past, and so that's the reason we really like this short-term rental strategy, because you can earn 2 to 3 times more utilizing the short-term rentals, STRs, through what we're talking about now. Mitchell was running it through his analyzer.
So let's talk about that. And sorry for some of the acronyms get thrown back and forth. STR, that's a short-term rental. LTR, that's a long-term rental. When most people are talking about real estate investment, instead of owning a rental house or maybe owning some apartments, they're talking about LTR, or a long-term rental, meaning that they have a lease for a year or so. And then sometimes they have multi-year leases, and a lot of times in a multi-year lease, they might have a rent escalator of around 3 to 4%. Some very astute landlords right now are actually using CPI, which is the Consumer Price Index, and right now it was at 8.2% this past month. It was 8.5% the month before that. And so if you're increasing by CPI, you're doing well. But even on a long-term rental, you're only adjusting the rent once per year, maybe once every 2 or 3 years, depending upon a really long lease term. But you're right, with the short-term rental, with the STR, it's literally every night that we can adjust pricing. And we also have surge pricing. I don't know if you've ever taken an Uber or something like that, where it's a concert or it's a football game. All of a sudden, the Uber price goes up 2 or 3 times or 4 times. We have the same ability to do that. And so we're always able to maximize that nightly rental that we can. And if we see that we've raised the prices too much and maybe our occupancy falls off, then we can very quickly adjust that back down to keep that occupancy high. Mitchell, where do you like to see the occupancy rates? What do you think the sweet spot is right now?
We pro forma all of our properties to hit about 80% occupancy, which seems ambitious. We've been proving it out pretty well, and actually a lot of our properties have been somewhere around the 85 to 90% range. So we're seeing the performance that we want out of them, and in doing so, we've been able to increase our nightly rates a little bit and still keep the occupancy that we have. So we have opportunities to raise the rates to hit the pro forma that we projected and go even further.
Okay. So sometimes you'll hear a term pro forma. What is a pro forma? What is that?
Pro formas are projections, our internal underwriting and strategy, and the projection that we have relative to the yield that we want to see and the performance of the property and the occupancy. So
yeah.
So all those things go into a pro forma.
So I keep harping on this 20% number, right? And I can, because as we say, okay, look, if we can get 20% on this property, we're going to do well. We want to roll with it. We want to purchase it and add it into the fund. So how have we been doing it? That's really like the proof is in the pudding, right? We have these pro formas that they look good and it looks like this is going to be a good investment. but Mitchell, you're on top of this. What have those numbers actually looked like on the properties that we purchased that we're running right now?
Yeah, the ones that have been active for an entire month at a minimum have been hitting or exceeding the 20% cash on cash. So we've been seeing the occupancy that we wanted to see. We're getting the rates that we expected to get out of the properties. The expenses are right in line with what we've performed out, and we're performing just above the 20% for the properties that have been live for more than a month.
That's good.
So it sounds like the strategy so far is working.
Yeah.
So far, Mitch, maybe you just give kind of an overview. You know, that there's a chart behind us. I don't know if the camera's catching that well enough, but give us a little bit of an overview. You went numbers before, but how many properties do we have live right now? How long did those take to come on? When are we getting more properties online? And just maybe step through that again, if you wouldn't mind.
Yeah, of course. We currently have 5 properties live on Airbnb. We've had 4 come online within the last month. We have 4 that we have under contract that are going to be live within the next 2 weeks. And we've increased our efficiencies as far as getting them online goes. When we were first closing on them, we were running about a month and a half to 2 months as we were figuring out what we wanted to do with furniture design, and as we worked with our property managers to get them all set up. The properties that we're about to have come online, we're down to about 3 weeks of property to get it from closed to live on Airbnb.
What does that process look like? Would you step us through that?
Sure. So we'll get a property under contract. We work to get it closed. There are a lot of things that go into that to get it ready to be closed. And then as we're going through that process, we're having our property managers go out and actively buy the furniture and design the unit and put it into a storage unit that we pay for up in Dallas. That way, when we close on the property, they get the keys, they go in there and they start immediately moving the furniture in. They get the listing all set up, they get all the photos taken, and then it goes live. So basically when we're closed, we've got everything that we need, and it's just a matter of getting it all set up and put onto our booking websites.
A lot of logistics.
Yeah, it sounds like there's a lot that goes into running and operating our strategy and doing this at a high level to make sure that the properties and the performance is successful. So I know Jeremy and I have a lot of conversations with investors and prospects about interest in that, and I think most people that are interested in real estate have heard about short-term rentals and the profitability and the good performance that can come from it. And but quickly the conversations go to asking us what's involved in that, or them sharing experiences personally. But there's quite a bit of management intensity that goes into operating a short-term rental, and I think a lot of people see the value in our fund, which is allowing them to participate in a portfolio that has these type of properties and operates this strategy, but doing so from a passive standpoint and not having to have the responsibility of procuring the furniture and timing that out and working with property managers and dealing with the dynamic pricing and surge pricing. So it's been impressive to see this and our improvement in operational efficiency, but I think it's, Jeremy, you could probably attest as well, but that's definitely a talking point that we share with people who are interested in short-term rentals, but maybe leery of all the intensity that goes into it from a management standpoint.
Yeah, that's a good point. And just with conversations recently I've had with investors and potential investors is that, okay, well, why would I not just go buy my own house and short-term rent it out? To your point, Brian, I mean, that is it. Do you want to actively manage it or do you want to passively manage it, right? And so that's where you really need to sit down and decide, okay, is this just going to be a little investment that I have? I'm interested in doing all the work myself. I can, go handle plumbing issues at 12 o'clock at night. I can go take care of tenants when needed. The triple T, right, is what we call it.
Yeah.
But basically that's the big decision, right? And it comes back to, okay, I do like real estate. I do like the short-term rental strategy. Do I want to actively manage it or come to a firm like Stallion and Stallion Growth Fund and passively manage it and potentially get similar returns, if not better returns, without having all the headaches? So
I think that's the big difference, right? So I know we've harped on this before, but if I go back to the short-term rental versus long-term rental, on the short-term rental side, we've seen revenues of 2 to 3 times as much, right? So if you get $3,000, maybe $3,500 on a long-term rental, we're seeing $9,000 to $10,000 per month on a short-term rental. And so there's a big difference in revenue there. Now, there's also more expense and there's more time because, again, instead of dealing with one tenant for a year or for a month, you might be dealing with 10 tenants over the course of that same month, right? So certainly a heavier lift, more money to be made because not only is the revenue higher, but the income is higher at the end of the month. So the income on a long-term rental, you might be looking at $1,000 if you're doing really well, if you're cash flowing. But on a short-term rental, we've seen anywhere from $3,000 to $3,500 per month, so significantly higher, but it is a lot more work. And so if you're doing this as a business, essentially kind of like what we're doing, I think it makes a lot of sense. But if you're doing it just for yourself, but on a regular basis, you have to be fairly committed to the process and working through it. So I think it's, the more I've looked at it, the more properties we've operated, I think it's a great way to make money in real estate, but there is a strong level of commitment. So like what you're saying, if we're putting out a 12%, a 13% rate of return to our investors, that's a pretty good rate of return for real estate, period. And that's without any appreciation. But they're not having to take an active role at all, right?
It's a big piece.
They just see it. So I think that's really kind of the differentiator between the growth fund and a lot of other real estate investments is the amount of return that's available still being in a passive position.
That's right.
Yeah. Mitchell, are you seeing any trends right now as far as the returns or the daily rentals on the properties that we own?
We have been able to adjust our pricing to keep up with the increase in inflation. It's just one benefit of being able to do Airbnb is as you see greater economic conditions change, you can be pretty dynamic in the way that you advertise and put your listings out there for guests. We haven't seen any sort of slowdown as far as the rentals go. Our properties have been staying occupied all throughout the month. We're getting requests for June and July already on some of them, so we're still seeing the same amount of traffic that we have been since January 1st.
Good. Nice to know.
That's a good point with inflation, not to kind of change gears a little bit, but with owning the asset and just owning an asset in general tends to be an inflationary hedge in this type of market that we're seeing. And so as we are owning these properties and building, a solid foundation of properties in there, that is an additional benefit to hedge against inflation for income coming in and the appreciation like Vincent and all of us have been talking about as well. So that's one of the drivers that really designed or went into us designing the fund is to combat inflation as we go along.
Combat inflation and as I was saying earlier, be a nice alternative to the traditional equities markets, which not to go into the details of the performance of the market, but I think we all know it's down and it's struggled this year. And really, we feel like we're positioned well to help investors who might be looking to transition some money away from the stock market or have some money through a recent transaction that they are looking to invest. Really feel like we offer a nice option for that, and with some stability being that it's hard asset backed by real estate, and that real estate being here in Central Texas in the major markets.
Yeah, good point, Brian. And Vince, going on those lines, can you kind of help explain a little bit as far as some advantages and potential disadvantages of maybe having money on the sideline, pros and cons of some of those? And
yeah, well, maybe I'll back a little bit. We'll just kind of look at what's going on in the economy for a second. So everyone knows we're experiencing inflation. We're at an official rate of 8.2% for May. The real rate is probably a little bit higher. I think I paid $4.96 per gallon this morning when I filled up my car. So
was that diesel?
No, that was
premium.
That was
premium.
So I think that's the highest ever paid. When you have energy costs that are like that, that just goes throughout the economy. So we're seeing food costs, energy costs, real estate prices, and rental cost all escalate significantly. In fact, I think when you're really kind of looking at the basket of goods and determining inflation, you're probably at double the official number. But without getting too deeply into that, it's a very real thing. Mm-hmm. So that means if you are holding cash in a bank account you're losing your purchasing power to the tune of somewhere between probably 10 and 15%, depending upon what you're buying over the past year. So I know a lot of people are looking at what's ahead of us and wanting to take a defensive position, and sometimes cash is a good place, but it doesn't seem like cash is a good place right now, because it's almost like you've got a little hole in your pocket where some change is kind of falling out every day. So cash is difficult. The equity markets have been volatile. I have no idea what the markets are going to be doing over the next month or over the next year, but they have been on a downward trajectory for most of this year, and the momentum is still to the negative side. That the equities could be the right call. We don't know, and I have some ideas about it, but it could be a great investment for the rest of the year, but we're really not sure. I do think it's going to be a volatile investment, because that's been the case for all of this year, and that will probably be the case. You have other assets, and I use the word assets because to me, you either have cash or you have assets that you're buying with the cash, right? So the cash is losing purchasing power. Putting money into assets might work well. So I think you have some people that have been putting their money into gold or silver. You have some other people that are just kind of looking at commodities in general. I think gold and silver can be a great strategy as a way to keep your purchasing power, right? And they've done well over the past couple of years. But the only thing about gold and silver is they're not necessarily a productive asset, meaning that they may keep the value of the cash that you put into them, right? So they're going to be doing better than holding dollars, but they're not generating dollars. And so to me, that's what's most interesting about real estate. If you have tenants like we do with our STRs, is that you are generating income with the assets that you're buying. And if you continue to generate income, that means that that asset has some inherent value. So the real estate market does seem to be slowing down because you have increased interest rates. Real estate's essentially getting more expensive from the standpoint of, with a higher interest rate, you're having to pay more for it. Mm-hmm. And so we've seen the number of homes slow as far as sales per month. There's also a very small supply though. So part of that's probably due to supply, part of that's due to the higher interest rates. But we haven't seen those values fall. And if real estate values go with inflation, where inflation's coming up and the real estate values are kind of mirroring that, I feel like having real estate as an asset is going to be a fairly good strategy. Now, you could have a decoupling where you have inflation continuing to go and real estate kind of tops out or even declines. But again, if you're making that income with that real estate, then that can be a great strategy for holding, even if you have a decline in value, because you're still making money with the asset. So I've had my eyes on this for a while, and I just really believe that at times of inflation, and I think personally that you're going to see inflation continue for another 12 to 24 months, that it's probably a good time to put money into assets that are paying you back, that are generating income, versus staying extremely safe with cash, because certainly it may not be a bad strategy, but we know that you are going to be losing purchasing power. I don't know by how much, but I believe that's going to continue over the next couple of years. And it's always tough when you're working hard for your money, when you actually see the value of it decreasing over time. So I think that's a big deal right now, and part of the strategy that we're working on.
Yeah, that's a great point. And what we're seeing, Brian and I, with investors and potential investors, is more questions about funds like ours, and because they are, an alternative to your traditional investment products. With our income debt funds that we talked about earlier, those are your traditional, your alternative to your traditional fixed income producing assets like your bank accounts, savings, bonds, CDs, and then the equity fund, the growth fund. Like Brian said earlier, it is kind of your comparable to the equities markets. But the one thing about both strategies is that they're non-correlated to the markets. And so the volatility that Vince was talking about a moment ago, you're not going to see with our product line. And so that's a big thing that we're seeing as well, where a lot of investors, I'm sure probably all of us too, I can't actually remember the last time I logged into my investment account, but we're seeing that volatility. And so as having a diversified portfolio, wanting to look at your entire strategy long term, see what makes sense for you, and take advantage where there's opportunities to take advantage of. And we really believe that real estate has a prime spot in your portfolio for the reasons that we've talked about.
For sure. And I think something else to mention along those lines, Jeremy, is helping investors understand that this is a portfolio of properties. So it's not just investing into one particular asset and, depending upon the success or failure of that one property. The nice diversification that we do is overall from the equities market, but in the portfolio structure, that there's a number of properties that are contributing to the performance of this. So a really nice component of it as well. And I think, sorry to interrupt, but another question that we get is, how long are we planning to own the properties that we're buying and putting in the portfolio? I know we talk a lot about short-term rental as a strategy, but maybe give a little insight on the projected timeline for the properties that we're buying and operating.
Yeah, very, very common question. And the answer to it is it's really a long-term hold strategy. And the reason is that if we have a property and it is generating a very healthy return, let's say in this case we're looking at 20% on the capital that's invested into that property. If it's continuing to perform at 20%, or if it even goes higher than that, due to inflation or due to just general rental rates increasing, that's an asset that I want to hold on to. And that's one of the reasons why we designed the growth fund as an open-ended fund, where that's not closed-ended funds. You'll have an investment raise period, a purchasing period for the properties, an operation period, and then a period where you're selling out those properties and returning that capital to the investors. I've always felt like if you have a great property that's creating a great return, why would you want to sell that property? So really with us, I believe that if we find out, or if we purchase a property, maybe it operates really well for a while and then the income falls off and the rate of return falls off, that would be a prime property to look at selling. But instead, if it continues to generate a great income, that's really a property that we want to hold on to, because say 20% rate of return is not that common in a lot of investments. And if that's something that remains consistent, that's really something that I like to hold on to. So I think once investors see that strategy, and we kind of ask, we say, if you have a short-term investment strategy, then the growth fund is not for you. If you're looking for a place up for something for a year or maybe two, there are probably some other investments that work well for you. But if you want to make money over the long term and you have a longer investment horizon, then the growth fund might be the vehicle you're looking for long-term appreciation. But that is a question that we get a lot, and I think for the right investor, we align pretty well. What are some of the other questions that we're getting right now? We'll maybe move into a frequently asked questions or just kind of concerns with the strategy or the real estate market.
Yeah, a lot of things I've been getting is of course inflation, what we've talked about. That's probably number one. We see that almost every day in the newspapers and headlines of what's going on. Rising interest rates, which what we've talked about too, and how we're battling that with our income debt funds, given their floating rate basis. But
let's talk about that for a second, though.
Yeah, and so which we can also tie into the growth fund, but because we haven't touched on that, because we utilize the growth fund where we have investor capital as our down payment, anywhere from about 20 to 25% down, and then the rest will be bank loan or bank debt on that property. Now with that bank debt, it is floating until we put a new property on that line of credit. Mitchell, you want to tell us a little bit more about that?
Sure, yeah. So we've gotten 2 lines of credit so far, and they're both prime plus a margin. And so until we get a property under contract, that has the potential to change. Once we do get a property under contract, then it's locked in through the close date. So the properties that we're buying right now, we're locked in at a relatively low rate, but we're going to see that start to climb as the rates start to climb in the market.
Let me add some clarity there. So, because I think it's pretty important. So on the debt funds, I'm going to go all the way back to the debt funds, floating rate, right? But with the money that we're borrowing on the properties, once we close on the property, that rate is locked for 5 years.
Correct.
Right? It can reset after 5 years, but 5 years is sometimes an eternity when you're talking about interest rates. Yeah, so it's floating, or it's a prime plus a margin until we close on the property, then it's locked. And so right now, when we're looking at closing on, if we close on properties next week, which we're going to be, we're going to be at about a 5% rate, but that'll be locked for the next 5 years. If the rates come down, we always have the option of refinancing, just like anyone else. But if the rates go up, we're still going to be at that 5% rate, right? So that is one concern that we have is as those rates do increase, our margin on the short-term rentals does decrease. So we would expect that if you have another 1% or 2% that the Fed raises the federal funds rate, that we would be getting less return on a property basis. But you're looking at maybe going from 20 down to 18 with some of the performance that we run, or maybe down to 17, but still a fairly healthy rate of return. Now, there could be a point where the rates get so high, I hope this isn't the case, but the rates get so high where it makes sense to change strategies. And so that's something that we'll be looking at. But my philosophy on it is, if there is still a strong return to be made by purchasing a property, even if the interest rates go up a few percentage points, and we can still make money for investors, it's probably something that we want to go ahead and do.
Yeah.
So certainly want to take a look at it, because lower interest rates are going to be better for the strategy. But because of the amount of income we can generate, we're less sensitive than, say, a long-term strategy, right, where you're getting significantly less revenue and you can't make up for it with these short-term rates that we're able to achieve. So I think but that is a big deal. That's probably the number 2 question, like you're saying, Jeremy, behind inflation is rising rates, and what are we going to do? What are we going to do about it? How are we going to address it? So that's important.
Yeah. Another one is in relation to, okay, what happens, when gas prices gets too high, or if we get into a recession, which we're starting to hear some talks about a potential recession next year, depending on what source you're looking at. And so you want to shed a little more light on that, just our thoughts?
Sure. Well, in a recession, everything gets hurt, right? There might be a few things that sustain themselves, but in general, a recession is going to be bad for the equity markets, be bad for the real estate markets, be bad for the job market. It's a difficult period that we'll have to get through. So we could see rental rates decline. We could see occupancy decline in those situations. I don't think it changes the fundamentals, though, of what we're looking at, right? So if you look at where we're investing, at Central Texas and up and down the I-35 corridor, for those people that are from Texas, right, from Dallas in the north to San Antonio in the south. We're also putting some properties, we'll get some properties in Houston that will be operating. But the fundamentals of these markets are pretty strong. So will they get hurt in a recession? Yeah, because it's a recession. It's going to affect everything across the board. But I think those will be the quickest to bounce back post-recession. And it could be that if we do go into recession, we might have more opportunity to go and get some great properties at a reduced price, because we plan to have capital at that point. And that might be when we can build the most value for investors. So we're not hoping for a recession at all. We would love things to just continue smoothly. But I think in those situations, especially if you have a recession with inflation, right? If you have stagflation, then I still think our strategy matches up pretty well, because if we're putting money in assets, even when you have stagflation, you still have the underlying value of these assets increasing. And I think we could do well. But it is a concern that we have, and we want to make sure that we're being very wise about where we're deploying capital. And that probably means that we're going to stick closer to city centers, which we already do, but even more so, because what I found in the last recession that we went through, the GFC, the Great Financial Crisis, was the outlying areas outside of the major cities were hit the worst. We had significant value declines there. But everything that was near the city centers, where we're purchasing properties, did reasonably well, because you still had a fairly strong market because of these population centers. And when you look at the cities where we're either investing or plan to invest, right, Dallas, strong population growth and a large population. Austin, same thing. San Antonio, same thing. Houston, same thing. These are some of the largest cities in the country that we're investing into. And I feel like that usually helps through a recession and then coming out of a recession as far as values, as far as rental rates, as far as occupancy goes. So I think we're very fortunate that we're operating in these markets that are some of the best in the country, which I think will help. So
Yeah, plus it seems like every other day we hear a new company coming to town in Austin or neighboring Central Texas areas. So yeah, strong demand.
Yeah, very fortunate to be doing business here. Very fortunate to have deep experience in all of these markets over the past 15 years of our track record as a lender and building the relationships and having market insight. All things that I feel like are helping us as we have launched the growth fund and really embarking on the strategy to acquire properties for the long term.
Well, we'll just maybe do a quick summary plan. So the plan for 2022 is continue to lend money out with our debt funds, bring that 7 to 8% return for the investors in there. We're looking for more capital inside of our debt fund. So if you have interest in coming into the debt fund, we have room. We believe that we're going to have sustained demand on that side because it's still a great place to be in the real estate business in Central Texas. And then on the growth fund, plan is to bring quite a few more properties online. We're always looking for properties that fit our requirements that we think would be a great investment for our clients. So that'll be continuing. We're looking again for, say, that 12 to 13%, maybe 14% rate of return for this year. Of course, anytime you're starting an equity fund, which is what the growth fund is, right, owning the real estate, there are a lot of expenses in buying those properties, and you're only making money once they are online. So we're making money.
Ramp up.
That's right. We're ramping up. So, but as we're ramping, we're going to be going into Q3. I think with 12 properties or more than that.
We're
Actually,
gonna have I think 13 of them.
13 properties. Got it. That'll be live, and then we'll be buying more properties throughout Q2 and Q3. And so, if you have interest in coming into the growth fund, we'd love to talk to you about it. Or if you want to just have a meeting with any of us to just go over some of your investment requirements or answer any questions, we'd love to do that with you. But putting kind of a line between the two. People are looking for income in their portfolios, turning their assets into income that they can spend on a quarterly basis. That's going to be Stallion Texas Real Estate Fund 1 and 2. If you're looking for long-term appreciation and really a great hedge against inflation, you're looking probably at the growth fund. Again, the growth fund is not putting income out into the pockets of our investors, but it's building long-term wealth. So we would love to talk to you. Thank you for sitting through the podcast with us. Anytime you'd like to come visit us at the office, we would love to have a meeting with you. If we can answer any questions, please give us a call or send us an email. Until next time, see you soon.